Okay, so learning objective 4 is really broken into two parts. The first part is, remember what you were just doing in learning objective 2 and learning objective 3 is you were doing those adjusting entries. Those adjusting entries are all journal entries. In other words, you put them in the journal. And you know what happens whenever you put things in the journal. They post to the ledger. So now, after you've done all those adjustments, guess what? Those accounts that you adjusted have new balances in the ledger. And so we need to do something called an adjusted trial balance to see if our accounts are balanced in the ledger. Okay. So again, all those adjusting entries you've just put them in the journal. All the things that you saw were journal entries. So remember what happens from chapter 3. At any time you put something in the journal, right, it posted to the ledger. So in the adjusting entries, thankfully, there were only 7 pairs of accounts that were affected. Learning objective 2, you had supplies, expense, and supplies. Right. You had insurance expense and prepaid insurance. You had depreciation expense and accumulated depreciation. You had unearned revenue and service revenue. In learning objective 3, you had accounts receivable and service revenue. You had your interest expense and interest payable. You had your salaries and wages expense and salaries payable. So those entries with those accounts, those are the only accounts that are going to be affected. So in essence, all we're doing is we're doing a trial balance after the adjustments. So the adjusted trial balance is really just a trial balance after doing those adjustments. And like I said, I just named all of the accounts that go through the adjustment process. So all of those accounts are going to have different balances, okay, because we adjusted them. Again, because anything we put in the journal is going to be transferred and posted into the ledger. So now, like I said, supplies and supplies expense have new balances. Prepaid insurance and insurance expense have new balances. We have to make sure that all the debit and credit balances still balance after those adjustments. And that's all the adjusted trial balance tells us. Okay. The wonderful thing about the adjusted trial balance is this is the primary information we use to prepare our financial statements. And you know that first one that we prepare is the income statement. It is the income statement. So now that once we've done our adjusted trial balance and it balances, we're ready to do the financial statements, starting with the income statement. So that's basically what you've got. Take a look here at everything that you learned over the last, through the last week. This is the adjusted trial balance for Sierra Corporation, which means this is the trial balance after those adjustments were made, right? And you'll notice that there are a list of accounts. The accounts are longer. There's more accounts listed here. And you'll notice that there's a lot of accounts that have balances that are printed in red. That's because those are the accounts that went through the adjusting process that we just learned last week. Okay. Which ones did we learn last week? Well, you know that you're going to have a supplies expense and supplies, right? Debit supplies expense, credit supplies. Well, that's why these numbers are red, is because they went through that adjustment process. You know you're going to have an insurance expense and prepaid insurance. That's also part of the adjustment process. So you know that those balances have changed afterwards. That's why they're red, right? You know you had a depreciation expense and you credited accumulated depreciation. So here's the depreciation expense and here's the accumulated depreciation account showing in red because that went through the process of adjustments. This is how they come out after they're posted to the ledger. We know we had unearned service revenue and service revenue were affected because that's the deferred revenue. We had to check to see if we actually earned any of this unearned revenue, and we did, right? Those numbers are red because these accounts went through that adjusting process. In Learning Objective 3, in the very last chapter, we have to set up an accounts receivable, right? So we can make sure we have service revenue claimed. That's why those two accounts, those numbers are in red. They went through the adjusting process. Learning Objective 3, accrued revenue. Now we have two accrued expenses you might remember, right? We have an interest expense that we're going to pay later, so we have an interest payable. As you notice, those accounts are also red because they went through the adjusting process last chapter. We also had a salaries and wages expense, but we set up a salaries and wages payable. You know that these balances are also red because they went through the adjustment process. It's very important that can everyone understand why those accounts are red, and you can trace it back to the last two learning objectives. You can match the accounts. Can everyone understand where I'm getting those matches from? Okay, that's critically important. The entire adjustment process, those pairs of accounts are always matched. It's the same pairs that are matched in the adjustment process. Okay, so if you're putting that in the journal, the numbers are going to travel to the ledger, and that means the balances are going to change just in those accounts. Just in those accounts. And that's why they're in red. Right. Very important. Very important. Okay, so now that we actually have the adjusted trial balance balanced, now we can actually do our financial statement. The most important one that we start with, as you know, the income statement, which shows our revenues and expenses. You already know that you're at this point, since you went through that double checking process of the adjustments, you're pretty darn sure that all the revenue is there, and you're pretty darn sure that all the expenses are there for the month of October for Sierra Corporation. Okay. So the income statement is probably going to come out as best as we can under the circumstances. Then we will do our retained earnings statement. Our retained earnings statement is based on the income statement because we add net income, which comes from the income statement, right? And we are pretty excited about our net income because we've spent all this time adjusting for revenue and expenses. And then once we're done with that, of course, we get the balance sheet. No big deal, right? You've done many of them. It's a classified balance sheet. But again, the balance sheet's going to be reflected. The retained earnings account is going to be transferred to the balance sheet, right? Because it's a stockholders' equity account. So this is what it looks like. If you have your book handy, it's probably going to be a little bit bigger than the slide. This is page 172 in your book. This is the adjusted trial balance that we just looked at from the previous page for Sierra Corporation. Okay. The very, very first financial statement that we do, as you know, is the income statement. This is for the month of October. Right? It's the periodicity assumption for the month of. That's the time period. So what we're going to be doing here, and that looks like an 11 rather than a 1. You know, the very first thing that goes on an income statement is revenue, and guess where we find that number? On the adjusted trial balance. Here's your revenue number, 10,000. Here's your revenue account, service revenue. is the number. That's where this comes from. Comes right from there. You know what goes next on the income statement are all the expenses. All the expenses are listed here. Where do they come from? Right here. All the expenses are listed here. All the amounts are listed here. They're just plopped up here in the income statement. The only thing we do is we total those up. We see that our expenses are lower than our revenue, or our revenue is greater than our expenses. So that's good news, because that usually means we have a profit. And indeed we do. We have net income of 2860. But just notice how all of these numbers on the income statement come from here, the adjusted trial balance, every single one. This is where we get the numbers to make the statements. Back in chapter 1, chapter 2, they were actually just giving you the numbers. In reality, if you wanted to do it yourself, you'd go to the ledger, or you'd print out an adjusted trial balance and just take, which takes the balances from the ledger. The only thing that's on the trial balance are the balances in the ledger. So it's just a transfer, that's all. The next statement that we do after we're done with the income statement is the retained earnings statement. Again, it measures the exact same period of time, the month of. The retained earnings statement mirrors the income statement in terms of time frame. Okay, so it's also part of that periodicity assumption, artificial time frames. First of all, we start with beginning retained earnings. That's going to be listed on the adjusted trial balance up front. And as you see here, the balance in retained earnings is 0. That's actually the beginning balance. We didn't know whether we had a profit yet. We had to calculate that on the income statement. So now that we have, we can go ahead and add that net income to net earnings. And then, after that, we subtract out dividends. Well, how do we know if we had dividends? Well, as you see, the dividends account is listed here on the adjusted trial balance, and your $500 balance is there. Dividends are taken away from the company. They're sent out. So they're taken out of retained earnings. So retained earnings actually ends the month with a balance of 2360. This ending balance of retained earnings is going to be transferred to the balance sheet. Okay, that's this number you're going to see again because you're going to put it on the balance sheet. And here's your balance sheet. Notice the balance sheet is simply the day. The balance sheet is not subject to periodicity assumption. It doesn't measure a period of time. It simply tells you what the assets, liabilities, and stockholders' equity is as of that day. That's it. Okay. As you see, assets are listed first, and all the asset accounts are listed here. Where all these come from? They come right out of the ledger as listed on the trial balance. Here's your balances. Remember, accumulated depreciation has a credit side balance because we subtract out accumulated depreciation from the equipment, leaving a book value. So all these numbers are coming from here. And then you have total assets of $21,910. Liabilities are listed next. Here you have all your liability accounts. Where are they coming from? Right here. Where liability accounts are listed right here. Again, this is the order they would normally be listed on. Your book here shows a slightly different order because it goes from larger number to smaller number. But technically, whatever is in the ledger is the order it would be in. Total liabilities, $95.50. Stockholders' equity, well, we know about common stock because that's given to us. Retained earnings, we figured out in the last statement. So we can move that $10,000 over to common stock, but the retained earnings balance comes from the previous statement, which is the retained earnings statement, 2360. 12,360 in stockholders' equity. When we add these two together, their total is 21,910, which matches our assets. Okay. not going to go over that. But that's basically the first part of Objective 4. Page 174 has this do it exercise on it. I mean, I personally am not totally thrilled about it because it doesn't show you exactly what you're supposed to be doing. It does it in different ways. It tells you the information for Slotnick, which was organized on April the 1st. Okay. And here they're preparing a quarterly statement because the amounts are adjusted as of June 30th. Okay. So this is the adjusted trial balance. So these are the final numbers that we're going to use for our statements. The first thing they want you to do is determine your net income. I would have much rather you just do a formal income statement because that would have been the first step. I would have actually preferred that you do a retained earnings statement right after that, but it doesn't do it in that order. What it does is say, all right, so give us a partial balance sheet. Tell me what the total assets are. Tell me what the total liabilities is as of that day. And then part C tells you what's the balance on retained earnings. So that's the only thing I don't like about this. Not that the numbers are bad, the period, everything else is fine. It's just that the order that they ask you to do things is not the same order that they've presented it in the book. So to determine net income, you know what you need, right? You need revenue. Now this particular company, look at this, they have two revenue accounts. They have service revenue and they have rent revenue. Those are the two revenue accounts. Oh, there's a revenue account up here. No, unearned rent revenue is a liability. That's not a revenue account. Rent and service revenue, these are your accounts. So these are going to be first on your statement. And then, of course, you need all your expenses. And again, all your expenses have debit side balances, as you would imagine. So here are your expenses, and those are the balances. So when you transfer that onto an income statement, which they don't formally do, but it is, you will see 15,000 of total revenue, 12,510 of total expenses. This company is profitable for this quarter, $2,490. Nothing to write home about, but a profit is better than anything. The next thing they want you to do is to put together assets and liabilities. So let's go back to our list. What are the total assets? Well, you have your asset account, all your asset accounts except accumulated depreciation have a debit balance. So cash all the way down to equipment, these are your asset accounts. Plus your accumulated depreciation is going to piggyback on the equipment with the assets because it's a contra asset account. So then when you look at your assets here, you'll see cash, receivables, supplies, prepaid. Prepaid rent is fine. Equipment minus accumulated depreciation gives you the book value. Total assets 23,350. Then they ask about your liabilities. If you go back, your liabilities will have credit balances, notes payable, all the way down to unearned revenue, rent revenue. These are your liability accounts. Those are the balances there. When you put it together, you'll have your liability accounts total to 7460. Okay. Again, the last thing they want you to do here is what's your balance in retained earnings. Again, I'd much rather have you do a retained earnings statement. So the first thing they start with, it's a new company, retained earnings April 1st, 0. How do we know that for sure? If you look on the adjusted trial balance, retained earnings is 0. 0. That's the starting point. That's the starting point. You add the net income. 2,490 comes from the income statement. 2,490. We subtract out dividends of 600. How do we know it's 600? Go back to the adjusted trial balance. Dividends, 600. Subtract that out. This is your retained earnings, 1,890. Okay. So, I mean, it's somewhat of a repeat of chapter 3, yes? You've done the journal entries. All those adjusting entries are journal entries. they've now posted to the ledger, but only in the accounts that were affected in the adjusting entries. So those accounts have new balances. You do a trial balance after the adjustments to see if it's balanced. That's the adjusted trial balance. And once that is balanced, you're good to go. You can start your financial statements right away. Okay. And your first financial statement is the income statement. You can feel pretty good about those numbers because of all those adjusting entries you've done. You've done everything you can to make sure all the revenue is there and all the expenses are there. So you can have pretty high degree of confidence that that income statement is good and that that profit or loss, whatever it shows us, is good. It's accurate. Then we do the retained earnings statement. How do we know what the dividends were? Well, it's on the adjusted trial balance as there. How do we know what the net profit is or net income? The income statement that we just did tells us. Retained earnings balance will be on the adjusted trial balance. That's the beginning balance. But in a new company, we'll always start at 0. Add the net income, take away the dividends. We got an ending balance. That's going to be transferred to the balance sheet. So nothing, I mean, other than the adjustments and there's something called the adjusted trial balance, you already know how all this stuff works. You know how to do an adjusted trial balance. You know how to balance it. You know how to do an income statement. You know how to do a retained earnings statement. And you know how to do a balance sheet. So in that sense, it's a repeat of everything that we've done early on. Any questions?